Welcome to the Connecticut Conference on Climate Change and Insurance. This is a panel on resiliency in action, specifically on financing. Thank you to Commissioner Mays and George Bradner for putting this panel and this event together. My name is Brian Garcia. I'm President and CEO of the Connecticut Green Bank. We've assembled an excellent panel today comprised of professionals with varying expertise as it applies to the topic of climate financing, and specifically resilience. I'm going to ask each of them to introduce themselves to give you a better sense of that expertise by delving into a specific question. But before we jump in, let me set some context. The Climate Policy Initiative has always been my go-to when it comes to climate finance capital flows. Their Global Landscape of Climate Finance 2021 report looks at climate finance trends from the perspectives of sources of capital, public versus private sources, the instruments for that capital, albeit they grants, debt, equity, etc. Uses of capital, are those uses for the mitigation of greenhouse gas emissions or adaptation and resilience, or both? And what sectors is that investment going towards? Energy, water, transportation, land use, and others. On average, about $632 billion of climate finance was invested each year in 2019 and 2020. About a 10% growth from the prior period, which doesn't yet show COVID-19's impact on climate finance, which, as you could imagine, is worrisome from a climate perspective. If we delve deeper into the sources of climate finance, we can see that the public sources represent 51%, while private sources represent 49%. Public sources increased by 7% from the prior period of 2017 and 2018, while private sources increased by 13%. And you can see the various public sources of climate finance from state-owned financial institutions to national development financial institutions. And you can also see the various private sources of climate finance from households and individuals to corporations. In terms of the instruments for that capital, we see that debt dominates at 60% of the capital flows, equity at about 35%, and grants at about 5%. Climate finance from grants increased by 33%, debt by 1%, and equity by 23% from one period to the next. So in general, what we observe is that there's about $630 billion of public and private climate finance a year in 2020. Again, this is pre-pandemic. About a 10% growth from the prior period, of which it is evenly split between the two sources, public and private sources of capital. Debt dominates the capital stack at 60%, as we'd expect, but is stagnant, with both grants and equity seeing significant growth. Given the topic of our panel, however, with its focus on resiliency, let's look at the uses of capital. A majority of climate finance went to mitigation at $571 billion, or 90%. While over $60 billion went to investments that include adaptation. Adaptation finance has always trailed mitigation significantly, but what is good here is to see the trend of increasing climate finance in adaptation, an increase annually of over 50%. Now, having said that, the public sector continues to provide almost all of adaptation finance, while the private sector mostly provides mitigation finance. From the perspective of a green bank, we always look at this problem of increasing investment in solutions to confront climate change by leveraging public sources to mobilize and attract multiples of private investment. So now let's come back down to earth and delve deeper with our panelists. Our panelists are going to bring perspectives from the public and private sources of resilience finance and the role of philanthropy in enabling more private investment in resilience. All right, so with that as some context, I'm going to ask each of our panelists now to introduce themselves. And we are going to start with Pete Caminiti. It would be great, Pete, if you could introduce yourself to our audience from the perspective of your expertise, as well as the role Zurich North America is playing to address the risks posed by climate change.
Sure. Thanks, Brian. So my name is Pete Caminiti. I'm our Chief Underwriting Officer and Property Technical Director for Zurich North America. Zurich's a global property and casualty insurance company with substantial operations here in North America. But actually, I think most relevant for this conversation is I'm actually our executive sponsor for North America Climate Resilience Program. And so when we at Zurich, when we think about climate resiliency and climate risk resiliency, we really think about three key audiences. We think about our customers, of course. We think about our employees, and then we think about the communities that we live and work in. And so when we think about from a customer perspective, there's products and services that we've developed and have made available to help our customers manage their climate risk, manage through transition risk. When it comes to our employees, we've got benefits and services that we offer to our employees. But when it came to our communities, that was the piece that we really wanted to figure out a way to have impact, because again, the communities are the foundation for everything that we do. So to try to find a way of addressing our communities, we knew it was something we couldn't do by ourselves. So we looked for a partner, and that's where we found the Resilient Cities Network. So Zurich, through its foundation, the Z-Zurich Foundation, in partnership with the Resilient Cities Network, have come up with a way to identify communities that have both a need and are actually ready and able to deploy certain resources. And it really gave us an opportunity to partner and create this connection between financing, our technical capabilities, but then with an organization that has the know-how and the network to begin working in local communities. So the community front has been a really interesting piece for us because that is something that we could not do by ourselves.
Great, thank you for that introduction, and I'm looking forward to delving further into that with Stuart when he comes up. But let's just dive a little bit further into the insurance industry a bit. So for insurance industry novices such as myself, so can you describe the regulatory structure for insurance? For example, who regulates the market when it comes to climate change? What are the roles of the federal government versus state governments when it comes to managing climate change risks?
Sure. Yeah, so the insurance regulatory market is a state and territory, 50 state and territory regulatory market. So insurance companies work with the departments of insurance in each state and territory. And really it's through product regulation, which is the way that insurance companies work most closely with those individual regulators. And so while that certainly creates a challenge for organizations that operate in multiple states, because of course we have multiple insurance departments we have to work with, the benefit of a system like that is you have local regulation for what really matters the most in those local communities. And so that allows state regulators to really focus on the needs of their local community. And so where we see benefit of that is, think about the United States, a huge geographic spread. The risk that you might have present in Connecticut is going to be different than the risk in Florida. It's going to be different than the risk in California. And that allows each state regulator to really focus on the needs of their constituents. The federal government, on the other hand, there's the National Association of Insurance Commissioners. So that brings together the network of each of the states and territories together, where they can come together and work on some common problems together, come up with some common solutions, set some common standards. So it's beneficial. So you get that balance of kind of a federal umbrella, but with very local regulation. The role of the federal government in this, I think, is when we start to get into things like various types of programs that the federal government may run, or when it comes into actually funding, certain types of initiatives. The role of the state regulation is really critical to making sure that some of the things that we're going to need to do in the future to address climate risk is going to have to be local. And it'll be really important for state legislatures, state regulators, the communities as well as the private sector to really come up with some local solutions. And I think that's where the regulatory structure that we have today will be really beneficial.
That's great. I think that notion of local knows best, is a very much fits in the federalist kind of principles. It's only us on the ground in our communities that knows what we need because of the impacts that we're feeling. So it does feel like, the role of state regulators in this context versus having somebody in Washington, D.C. making decisions is a good place to be in the context of this. All right. So next up is Taryn Akiyama. So Taryn, I'm going to ask you to introduce yourself to our audience from the perspective, again, of your area of expertise, and specifically some of the things that Climate Finance Advisors, a member of WSP, has been working on to address resilience. I know you're working on this. Perhaps there are some lessons from abroad that may be applicable here in the United States based on your firm's work. So Taryn.
Sure. Thanks so much, Brian. I'm delighted to be speaking with you all today on the really pressing and urgent topic of climate adaptation and resilience investment. So I'm a project consultant at Climate Finance Advisors, or CFA, and we work at the intersection of climate and investment. And earlier this year, we were acquired by WSP, a global leader in sustainability, engineering, and design. And what this means in practice is that we can serve as a one-stop shop for climate adaptation and resilience investment, as well as infrastructure. So for example, we can help our clients with strategies for financing and funding adaptation resilience or structuring funds. We can actually help clients with federal grant applications for resilient infrastructure, and we can help to engineer the infrastructure of tomorrow, which we like to call future ready. So at CFA specifically, we support our clients on the funding side of adaptation resilience. So for example, we provided snapshots of 26 federal resilience funding programs geared at U.S. Climate Alliance states, and that was published in USCA's Governor's Climate Resilience Playbook last year. Another publication that we contributed to was the American Society of Adaptation Professionals and Climate Resilient Consulting's Ready to Fund Resilience Toolkit, which was released earlier this year. So that's a little bit on how we support our clients on the funding side, but we also support our clients on the financing side of adaptation resilience. So one of our major projects last year was centered on what can we learn from European member, one of our main projects last year centered on what can we learn from EU member states and how can we apply that to the context of US states. So while adaptation resilience, as we know, are driven a lot by local context, there's still a lot that we can learn from one another and in order to scale action on climate change. So through this project, we facilitated cooperation between EU member states and US state governments on various topics, including how can we leverage insurance incentives, such as reduced insurance premiums, to incentivize property owners to make their properties more resilient to climate hazards? Or how can we help to establish a fund to support local governments and community stakeholders in resiliency planning, investment needs and prioritization, and project financing through capital grants, equity grants, or loans? And then another project centered on how to determine actionable options and the best methods for revenue generation for climate resilience, including own source revenue and blended finance. So our team has been working with the state of Connecticut and many different agencies for over a year, and we're really excited to be working with them and tackle the thorny challenge of how to both fund and finance adaptation resilience.
Excellent. Thank you for that introduction there, Taryn. And I can say, as one of the U.S. Climate Alliance states, as Connecticut is, I think we're one of 25 or 26 Climate Alliance states around the country. We represent, I think, about 40% of 60% of the population or GDP and 40% of the emissions. So you can have economic development at the same time, keeping our emissions down, and just really appreciate all the support that you've provided the USCA states over time. And then you also, I think, subtly gave our audience here a distinction between funding and financing. And I'll point it out, maybe you'll go into this deeper, but I think what you're saying is funding is a source of money coming in that doesn't have to be paid back. in financing maybe funding that's coming in, but you do have to pay it back. So you're using them in a distinct way. Is that just a quick? Yeah. Okay. Cool.
Yeah, absolutely.
Cool. So we'll go into that further as we get into the funding questions. So thank you for that introduction there, Taryn. The Climate Policy Initiative research shows several things when it comes to the role of public sources of climate finance as it applies to the area of resilience. First, when it comes to resilience, the public sector dominates. And second, that there's a trend towards increasing resilience finance capital flows. So tell us a little bit about the landscape for federal funding opportunities for resilience from the Infrastructure Investment and Jobs Act, the Inflation Reduction Act, or other things that you see coming out of the federal government.
So I would say that the CPI research on global finance trends is very similar to US climate finance trends. There hasn't been, to my knowledge, a study of that same Sankey diagram done at the US level because it's very complex and very difficult to gather all that data. But at a high level, would agree that a lot of the investment at this point on adaptation resilience has come from government, whether that's federal, state, and local levels. While it's been a little bit slow to progress on this issue, more recently, especially in the last year, this has been a really exciting time for adaptation and resilience in the U.S. The recently passed Infrastructure Investment and Jobs Act, IIJA, also known as the Bipartisan Infrastructure Law or Bill, as well as the Inflation Reduction Act or IRA. So lots of alphabet soup for you. Because the IRA is still relatively new and centered on climate mitigation and clean energy, for today, I'm just going to do a deeper dive into IIJA, which is a little bit more centered on climate resilience and adaptation. So as you can see from my slide, the IIJA encompasses many different types of topics. Overall, it encompasses approximately $841 billion to be allocated over the next 5 years. And right now, the slide shows in terms of the funding in millions. So overall, IIJA encompasses 378 new and existing programs. And you can see here it's broken down in different ways. Resilience on the far left here is the one with the most programs at 99. And you can see kind of the smattering of others. Just for illustrative purposes, it's not perfectly like this. I did the shades of salmon is a little bit more related to resilience and adaptation. The shades of blue are a little bit more related to mitigation, and gray is more other or miscellaneous. So you can see here from the left, resilience and adaptation with the 99 new programs it's an exciting time because there's lots of money and lots of programs being developed around this topic. However, when you look a little bit deeper into how that translates to funding, you can see how things slightly change. So when you look at it in terms of funding, resilience ends up being about 37 billion or 38 billion rounded up, and it makes a smaller fraction of the funds going into IIJA overall. And a lot of that is actually going towards roads, bridges, and major projects. And you can see water also is a big part. So they're definitely resilience related. But in terms of the resilience specific category as defined by the federal government, that equates to about 38. And if we look into just a spotlight on a couple, I won't spend too much time on these, but I've just highlighted a few that fall under that resilience category that make up the greatest funding. So there's the Federal Highway Administration's PROTECT program, which is on formula and competitive grants related to transportation infrastructure. There's a FEMA's Flood Mitigation Assistance Grants, which focuses on flood risk, and particularly with regard to National Flood Insurance Program. There's the Army Corps of Engineers Coastal Storm Risk Management, Hurricane, and Storm Damage Reduction Projects, which focuses on different infrastructure projects. And then moving forward a little bit more, there's also a similar project on inland flood risk management projects. And FEMA has a Building Resilient Infrastructure in Communities program, which relates to capability and capacity building activities for hazard mitigation. And then finally, there's the Safeguarding Tomorrow through Ongoing Risk Mitigation or STORM Act, which I won't speak too much right now because I know they'll be covered later.
Well, that was great. Thank you for that overview. And yeah, I was going to say that we're going to come back to that Storm Act later. We're going to advise the White House in terms of how to think about that. What's really interesting in terms of your presentation are a couple things. One is I hadn't thought about the IIJA from the perspective of mitigation versus resilience. And clearly it feels like the IIJA programmatically is more of a resilience build out as opposed to mitigation of greenhouse gas emissions. The second lesson I think I take there is that as we build our roads, bridges, and major projects, we really need to make sure that those are going to be resilient to the impacts of climate change, since it's a large part of the investment from the federal government in that infrastructure. So thank you for that introduction there, Taryn. So now let's turn to Kimberly Cornett, and I'm going to let you introduce yourself, Kimberly, and talk about what the Robert Woods Johnson Foundation is doing to mobilize private investment in resilience in the United States. And really, what makes a $15 billion foundation interested in the insurance sector?
So I'm so happy to be here. Thanks for inviting me. I learned something from Taryn already, so it's great to be with such a distinguished group of guests. So I'm Kimberly Cornett. I lead the impact investing program at the Robert Wood Johnson Foundation. We are a large private foundation based in Princeton, New Jersey, exclusively focused on health equity. So we come to climate resilience and climate change actually through the prism of health. And I think there is a growing awareness that in many ways, climate change is the visible, we see the visible impacts of that, but really the downstream effects really show up in doctors' offices and emergency rooms further down the line as people show up experiencing asthma from mold, extreme fatigue from heat, loss of property, which in some cases results in people not being able to have power to support their medical equipment. And so we're really looking at trying to mitigate the effects of climate change using our investment tools of debt, equity, and guarantees as a way to really ensure that particularly the most vulnerable communities can also remain healthy. And we all know that climate change is here to stay with us, and more people are having that personal experience where their health is really being impacted after a climate resulting event. So what we're doing is really looking at who are the major actors, in addition to the federal government, which Taryn outlined so nicely, who have a business interest that is aligned with our goals around health. And when we look around the capital markets, insurers really come to mind. Insurers, we believe, benefit when people and entire households and communities are stronger, more resilient, when their homes are more resilient. And so we've been looking to create partnerships with different elements of the insurance sector to try to bring more capital to communities to make those resilient investments as a way of really ultimately helping people to be healthier.
So that's great. So tell us more about this work. I think Pete mentioned the NAIC, but tell us a little bit more about this work that you're doing funding insurance commissioners' offices.
Sure. So one of the great things about being an investor inside of philanthropy is that we have a range of tools that we can bring to bear against a problem. And one of those is grants, and then we have a suite of investment tools. But we often know that it takes some pre-development money, if you will, to get a conversation going. And so as we looked at how could we bring more capital from the insurance sector, more of the best capital from the insurance sector to community development, we really realized it was going to require several interventions. And one was building relationships with insurance commissioners who had aligned interests, who also were seeing the impacts of climate change and the resulting impacts in people's health within their communities and wanted to do something about it. So we're very pleased that we have established grant-making relationships with six state insurance commissioner offices and their aligned nonprofit partners to begin kind of getting the flywheel moving about what are the responses that an insurance commissioner could consider, whether that be policy change, whether that be new partnerships, whether that be a capital market solution. So we're really trying to build a cohort across the country of insurance commissioners who are really thinking quite boldly about what the role of their office is in being able to mobilize the financial and the policy resources that are going to be needed in order to get individuals, families, and communities to the place where they are most resilient to the impending effects of climate change.
So I wanted to say on behalf of Connecticut, thank you for your support. Because Connecticut is one of those states, and I'm sure if Commissioner Mays were here, what he would say is that in the context of the project that you're supporting here in Connecticut, climate smart technologies really matter, and they matter for those who reside in affordable housing, but specifically those in affordable housing that may have pre-existing medical conditions. So, in the event the hurricane comes through and knocks out the power, what happens to those that rely on that power system? So we're really going to dive into that a bit, try to understand what the needs are, and then ultimately try to figure out how we can identify investment opportunities that are going to both reduce greenhouse gas emissions, probably reduce some energy burden too, reduce those energy costs, but also understand how those measures can improve their resilience. So, for example, whether it is battery storage when the grid is down, that's one thing, whether it's a hot day and making sure that these residents have a cool place to go, all those sorts of things. So just want to say thank you for that support. And again, as we look into that, our goal is going to be, okay, let's figure out some investments. Let's do some investments with the goal of attracting the insurance and the healthcare industry into this space, because it is really a public health matter, to your point. So,
what you will learn in Connecticut, we hope is going to inform many states. I'm sure many of us heard over the summer, Arizona experiencing, over 90 days this calendar year of temperatures over 100. And one public official was on the radio saying that grid failure in that state is something that they have to plan for. That's a Katrina-like event that for people, as you say, Brian, who are dependent on medical technologies at home could be, life-threatening. So really, I thank you guys, because I hope that you're going to uncover, some solutions that work in Connecticut that other states could consider replicating as well.
Great. Well, thank you for that introduction. All right. And lastly, we have, as part of our panel here today, Stuart Sarkozy-Bonisi. And Stuart, why don't you take a moment to introduce yourself to our audience and your expertise, and talk about the role of the Resilient Cities Network that we heard from Pete, and what role it's playing in terms of encouraging a more private investment in climate finance.
Sure. Thanks, Brian. And great to have this moment to discuss all this with the panelists, and just sort of listening to everybody. It's always hard to go last, but sometimes when you are last, you sort of hear the flow in a really natural way. And hopefully what I say will sort of add to that and get into our discussion. So again, my name is Stuart Sarkozy-Bonisi. I'm the Global Director for Policy and Investments at Resilient Cities Network. And in that portfolio, part of what's relevant today is I'm in charge of the launch and management of the Resilient Community Impact Funds, the RCI funds, and a coalition that's called the Resilience 21 Coalition, a policy effort that's made up of resilience practitioners all around the United States and beyond, actually. That came out of the late 2020 wish to influence the federal government and other layers of the government based on the experience that we had with the cities themselves. So I've been involved with Resilient Cities Network and what was 100 Resilient Cities since its beginning in 2013. And in this process, we have continued to sort of really bear down on what we mean by resilience. And in some ways, Pete mentioning how we're partnering gets at the heart of that definition, because we don't see it as just the shocks of natural disasters. We do not see it as just the stresses that are already there. It's the combination. And our definition of resilience means that we're looking at not just survival, not just adaptation, but thriving. And that's the part that's most difficult because we often don't plan to do the pre-recovery work. We're often in recovery a lot. And that goes with health, that goes with infrastructure, that goes with a lot of this. So for us, it's a very holistic, equitable view of what we mean by resilience. And that means where the shocks and stresses collide, we want to be there to be doing the work that builds the resilience out ahead of time. And as Pete said, we have partnered with the Zed Zurich Foundation and Zurich North America on the new program. But one interesting piece about the program is that Resilience for Communities program lifts up the ways that we work, because it's programmatic, it's implementation, it's policy, and it's also funding. And it's the funding and finance, and the definition was nicely made already by Taryn, but the idea being that we have to be able to step in to do some of the project preparation funding and some of the grant making that happens ahead of time, so that the financing pieces that really put those projects on the ground make the difference in those communities from that holistic nature, not just building a wall, building a bridge, building a road. All those things are important. But when you sort of think about the matrix of holistic resilience, we want to be in there with the cities. And sometimes it's smaller cities and sometimes it's larger cities, because they all have a role in that solution set.
So it sounds like the importance of that pre-development funding to pre-recovery, I like that term, is really, really important. There kind of is a strong nexus there in terms of some of that early stage investment to help people thrive. I like how you're thinking about resilience in that connotation, because that's really what it's all about. We want to thrive and not just recover. So in preparation for this panel, I know as we were chatting, you were excited by a number of federal policies that passed or may have bipartisan support and like in the process. So in addition to Taryn's overview, what else is out there that excites you, and why? What should our audience be looking for?
Yeah, I think there's a couple of them. And the one that we've been working on the most through Resilient Cities Network and the Resilience 21 Coalition is the National Climate Adaptation and Resilience Strategy bill, the NCARS bill. And part of the reason is that it's the piece of the work for resilience building at the federal level that puts the framing together, because it offers up a chief resilience officer for the federal government. It offers up the interconnection between the agencies, because having been in the federal government and having worked on the Hurricane Sandy task force, it's the integration of silos that we all know are there that often prevents us from getting to the resilience that we really want. And so the measures, including some of the equity measurement pieces, so measurement and measures that are in the NCARS bill, really start to get us to that kind of common framing and common language. Because in a lot of places, whether it's the city, state, or the federal government, we're often still working with different definitions and silos that do not blend one agency or cabinet member or whatever it might be together with the other one. That's one that we're excited about. Another one is what's called CEDARS. It's the Community Development Resilience Zones Act, where we would look at this cross section of where, again, it's the kind of places where you've got Cancer Alley and impacts to low to moderate income communities, plus dangers from natural disasters and economic issues that have been there based on redlining that's decades and decades and decades old. And then the hurricane comes, right? So we're trying to get in front of this by also supporting places that already feel like the shocks and stresses are pretty heavy, pretty burdensome. And this relates to what Kimberly said. And we talked about this at the NAIC conference in April in Kansas City. Where you have those health issues, they are only going to be worse, and COVID sort of proved that. So the cascading effects of the kinds of things that we saw during COVID, and when a big shock comes like a hurricane, should point to those kinds of things that we feel are coming through these pieces of legislation. There are others as well. And again, it's the policy and how we spend the money and the money itself in combination with other sectors kind of funding coming together. And that sort of intersection is what we're really excited about and looking forward to.
All right, so let's shift gears here a bit from the introductions to some open questions, and let's start off with the government response. So, beyond what we expect to see with respect to climate finance impacts, from COVID in 2020 and 2021, the data that we looked at was 2018 and 2019. 2022 is clearly the year that climate change demonstrated its wrath around the world, including the recent hurricanes that we saw in Florida. So what do you all expect to see more at the local, state, and national level in terms of responding to climate change from a resiliency perspective? For example, you had noted there, Stuart, are we going to start seeing chief resiliency officers in our communities and corporations? And why don't we start with Taryn?
I think from my perspective, resilience is such a inclusive issue. It really brings together all kinds of people. It really brings it home of why climate change, how it affects them personally. I think we can reach so much more people with resilience and adaptation because it has to do with their specific communities and how they're being hurt and what hazards they're facing and, what are the solutions for that area. And so I'm really hopeful that this is an issue that won't get too politicized going forward. And it's one that we can find more agreement on and accelerate funding in this regard. But in particular, I think resilient infrastructure, I think, is going to be really, really important in the next decade, because a lot of the infrastructure that's going to be built out through these IIJA and IRA funding over the next 5 years, they're going to have really long lifespans. And so it's really, really critical that we make sure that the infrastructure that's being built now is going to be able to withstand the hazards that we'll face 50 years from now, maybe even 100 years from now, and really ensuring that we are building them with the latest climate science and climate models in mind, while also recognizing that we might need to adapt as we go and course correct along the way.
So modernizing the infrastructure that we're doing now with all this investment also means making it more resilient to the impacts of climate. Very cool. I think maybe that's something the bipartisan, because it's the bill, maybe that's why we've seen so much investment in resilience coming through the IIJA as opposed to the IRA. So thank you for that. Why don't we go to Pete?
Yeah, Brian, when I think about resilience, unfortunately, I find that resilience tends to be the thing that we turn to once we've learned that rebuild and recovery is no longer effectively working for us. So there's unfortunately some hard lessons that have to be learned before we really start to turn to resilience and realize that we're going to have to do something differently. And as you pointed out, 2022 or even the past couple of years have really played out for us that there have been a number of situations where I think people are starting to realize that resiliency will be the way that we're going to need to deal with some of this. And we've got some really good examples of where we're starting to see that have some meaningful impact. So, I think the bright side of this is, with disaster, with catastrophe, comes this kind of rebirth of, how to best address these problems going forward. And so I do hope from here we can use some of what we've experienced over the last couple of years to really jumpstart some of the response and addressing the need for resiliency.
So thinking about it before and maybe investing in it before it happens, it feels very pre-covery to me. Stuart, why don't we go to you?
Yeah, thanks. It does. And yet it's really hard. Humans are not great at paying for things that are not supposed to happen, or lessening those things that are not supposed to happen, from wills to healthcare to insurance sometimes, right? So I think what we're starting to see, though, is the response that you need to do in many cases, even if the natural disaster isn't so natural, can be lessened if you're prepared in various ways. And that's just in the basic kind of rapid response and recovery kinds of activities. But I think what I'm hopeful for is that there is, as with the NCARS bill, a bipartisan nature around resilience building, because it means security, it means safety, it means risk reduction. And in that sense, that's where we're seeing our partners like Zurich and other insurance companies and banking and other elements of society kind of coming together to say, you're right, look at the cascading effects that we saw. We can prevent some of the cascading effects by being smarter on the front end. So I'm hopeful because the money is in there. My broken record piece is that how we spend it will be even more important than what's in there or where we're spending it in some cases. So how we spend it from an equitable standpoint is going to be really important. And I'm hoping we're ahead of that curve a little bit this time.
So I suspect what we'll start to see from the Climate Policy Initiative is maybe in its 2023, 2024 reports, continued increase not only in global investment in climate finance, mitigation and adaptation and resilience, but we'll start to see resilience start to tick up proportionately and be more in the overall context. And beyond recovery, to your point, this is about thriving. So the full, let's get out of the always thinking about its disaster. I think that's a real important lesson for all of us to take. All right, Kimberly.
So I would echo what Stuart says in that it is hard for us as humans, but particularly for government, to pay for things that are not going to deliver a benefit till many years down the road. And that's particularly difficult for elected leaders, where those benefits are going to accrue probably outside of the time of their tenure. Many of us will remember from the recovery from the Great Recession that there was a scanning of the universe for shovel-ready projects. And the truth is that in the most vulnerable communities, those projects probably are not shovel-ready, but they are shovel-worthy. And so I think what we have been focused on is what is the early funding and financing that needs to go to communities first to get them ready. And that is often a combination of at-risk capital and technical assistance. So as just one example, we provided a $5 million loan to an organization called Communities Unlimited. They're based in the Deep South. They are pairing pre-development financing for water utilities who intend to make application to the state revolving funds with technical assistance in an effort to get those communities to the starting line. And I think that is, we're at a historic moment right now with so much investment coming from the federal government. But I think it is beholden on all of us, certainly in philanthropy, in kind of the community development finance sector, to prepare those communities to get to the starting line. This is a very complicated undertaking for a community that is, low on capital and might be low on capacity too, but they too deserve the opportunity to have those investments in their community. So I would just say that, I think one of the policy aspirations that we're hoping for is a greater awareness into future funding that pre-development really is a key part of the recipe of success in having many different communities benefit from these historic level of investments.
And it sounds like from that the focus on vulnerable communities, those who have contributed the least to the problem but bear a majority of the impact is really important. And, in Connecticut, as we went through Tropical Storm Isaias a couple of years ago, our Public Utilities Regulatory Authority really prioritized vulnerable communities. Our legislature passed an act and really wants to focus on enabling more resilience with targets towards vulnerable communities to enable that investment to lift in their community. So great. Thank you for grounding us in that important equity Justice 40 initiative focus. All right, so we've been having this conversation around investment. So let's move to private investment. And, what is it really going to take to unlock private investment in climate finance and resilience? Given the wildfires, the droughts, the floods, and more happening around the world, will private investment naturally increase as a result, or is there a role for government to encourage that investment? And we're going to start off with Pete. I want to start off with you because we really want to understand the drivers to insurance companies in terms of their potential investment in resilience, as a preventative measure before a climate-related natural disaster occurs.
Yeah, I'll start with your question around Just the private investment, will it naturally occur? I go back to a comment I made earlier. I think it will when it becomes a matter of necessity, right? And that's usually when you see people start to make those investments, is when they've come to that realization that the repair, the rebuild is just not sustainable. And so you do start to see some of that private investment start to occur. And from an insurance perspective, when we think about private investment from an insurance standpoint, or the role of government here, and one of the challenges for us as an insurer, and so we're primarily a large commercial insurer across the United States with mid-sized customers up to large multinationals. For us, I mean, we certainly see opportunities and always encourage that investment from our customer in improving their risk landscape. But when it comes to climate, there's a particular challenge with transition risk. And I think there's a place for public-private partnership to really help manage through transition risk. So as an example, there may be a particular hazard or particular risk that a customer or community is vulnerable to. We can certainly, from an insurance perspective, see the path to where that would become a better insured risk for us, a more resilient customer. But the challenge is getting them from where they're at today to that place would require us as an insurance company to assume more risk than we would be today to be able to lean in and try to work in that area. So we need to figure out from an insurance industry perspective, and I think this is where we could do it with some help from public-private partnerships, is how can we lean into those areas where there is transition risk, figure out new ways to mitigate that transition risk, make it manageable so that we can make the necessary investments. And once those investments pay out, we would certainly have a much more resilient customer, much more resilient community, and ultimately a more insurable risk for us. So it's really about figuring out how to get from where we're at today to beyond that transition risk, and that's the challenge that we're faced with every day right now.
So let's keep going. So Stuart, any follow on to Pete's response there? What sort of perhaps technical and financial assistance, before versus after, does the Resilient Community Impact Fund provide? Funding is always important, as we know, but you also provide, based on what you were talking about before, technical assistance too, right? So could you talk about both the financial and the technical assistance of the program?
Yeah, I mean, my shorthand for this is kind of tools, pools, and partners. And the reason I say it that way is that we know we have things we want to do to kind of like push the measurement and push the assessment and push the impact and the tracking. But we also know that we need the funding in there, and that's funding and finance. We decided to set up the Resilient Community Impact Funds to be on the front end with those tools so that we're pushing further down and bringing our cities together with these public-private partnerships. Because I agree with Pete. I mean, I think there's a necessity that will come. Our role is to really sit with the cities and start to say, how do we bring everybody together to do this work? And sometimes that will take us being the one to kind of trigger the incentivized funding and doing a bunch of technical assistance ahead of time and the project preparation. It could actually mean the policy and the legislation, everything from zoning to sort of like business taxes and laws has to get adjusted. We're about to launch the first cohort of what we're calling the Global Risk and Resilience Fellowship with secondees from insurance companies in cities around the world. And if you think about how they would interact and kind of propose ways to work together, at the same time, we just announced this investment protocol for coastal communities, coastal cities. And in that investment protocol, we have kind of what we call the blue paper that says, we need the technical, we need the financial, we need the capacity building, and we need the funding and finance to kind of work in a kind of flow in a system. And so we sit kind of in the middle with that. We're responsible to our cities. We work with people like Zurich who have the same responsibility from the insurance side. So we want to kind of, it's a bit of a clash sometimes, not with Zurich. It's been kind of amazing actually, but there are companies who kind of look at us like, well, what do you mean you want us to step into this space? And do something different with the government? Doesn't the government just do this already? So I think what what we'll see is not just necessity, but also all of us that are sitting around the table right now kind of pushing a little bit further. Because Kimberly described some of that even in her own work, right? It starts to, you get in there ahead of time with people and kind of lift them up and move it together at the same time.
I was going to say that's a natural transition to Kimberly, because it really feels like the question here that you posed is what's the role that philanthropy can play in this part here. And Kimberly, I'd be interested in knowing if there is an investment opportunity with the foundation, and who are you hoping to partner with as you think about these investments?
So I like to say that the place that we like to be the most is where the perception of risk is higher than actual risk, or where the benefits, those long-term benefits that we talked about, need to season or kind of mature in order for an investor to be comfortable. Those are the kinds of risks that are well suited for the foundation and the social impact goals that we're trying to achieve. So I would kind of go back to an example of a transaction that we did a number of years ago, where the federal government had a new credit program. But if you're familiar with the feds, they like all losses to net to zero, no losses to the taxpayer, which is a fine goal. But that often requires, finding different pots of credit enhancement. And we believed that in this particular situation, the Treasury Department was overestimating the risk of one particular asset class that we believed had a performance track record, but they just needed to see it and experience it. So the foundation provided a guarantee for 3 years in order to let a portfolio of mortgages season and to demonstrate their financeability and on-time performance payment. And then after that, everybody agreed that, in fact, that asset class had proven its worthiness, and we were able to back the credit enhancement down. That's really what we like to do for the government, for private investors, for intermediaries like green banks and CDFIs, is we want to help get the appropriate entity in the transaction, and then to be able to slowly kind of take off the training wheels as the assets perform.
I was going to say that feels very green bankish, in that you're de-risking things so that certain sectors of the private markets can come in to provide their capital. And, in the green bank sector, I feel like we've done similar things to bring the banking industry in. And whether that's motivated by the Community Reinvestment Act, whether it's motivated by risk return expectations, and we're helping them get their return, you're trying to bring that big, large source of private capital in to solve the problem. That's great. All right, so now what's it going to take? I'm going to show you an image. We talked about a little bit about this before in terms of global climate finance. And I'm going to ask several of you, what's it going to take to increase public and private investment to confront climate change? Earlier, I was talking about trends in climate finance globally. And this is the blue area here on this curve. You remember the $630 billion roughly in 2018 and 2019 going into climate finance, 50-50 of that coming from public and private sources, roughly, 60% debt, 35% equity, 5% grants, and 90% of it being targeted to mitigation versus 10%, but on adaptation, but the adaptation was rising. So it's kind of fitting with a lot of what you all are saying. So, but we're currently nowhere where we need to be in terms of annual climate finance being, $4.35 trillion a year to meet our climate objectives. So why don't we start with Taryn, just in terms of what do you think it's going to take to get there?
Sure. I think the panelists have spoken to a lot of this already, but just really engaging, public-private partnerships and working together on these issues. I think it's become very clear that the federal funding alone is not going to be able to solve the problem. I think NOAA tracks climate events that have cost more than $1 billion, and this just increasingly grows and grows each year. And so while it is amazing that the federal government has has increased funding in this area. I really think that it's going to require action from the private sector and public-private partnerships to really move the needle. And one example of this that I just want to highlight, given that this is a climate change and insurance summit, is the Strengthen Alabama Homes program. This is through the Alabama Department of Insurance. And what's interesting about this program is it focuses on the climate hazards from, or wind specifically, and the impact of wind on single family homes. And what's interesting about this program is that it's not funded by federal grants nor the state's budget, but it's actually funded by the insurance industry. And so they provide funding that allows for, they provide funding that allows for Alabama homeowners to enact different measures on their properties up to $10,000. And this reduces the amount that they have to pay on their wind premium. So depending on the level of mitigation, there's 3 different standards they use, from fortified program through IBHS. There's fortified roof, fortified silver, and fortified gold. And depending on what level they achieve and how ambitious they are in terms of addressing a wind mitigation, they get discounts between 20 to 60% on the wind portion of their insurance premium. So this is just one example of ways that the insurance industry could be more of an active player in promoting resilience, and particularly in the residential property area, which needs more attention. So there's a study from the University of Alabama that found that the homes that met the fortified standards sold for nearly 7% more than non-fortified homes. So this ends up being not only beneficial on the insurance industry side because they have less to pay out in claims, but it's also helpful for the homeowner because then they can sell their homes for more money.
Perfect. So we'll come back to you, Kimberly, right now. Justin, I think what we want to do is take what Taryn just said there and move it back to her final response, and then have my little whatever point. And then why don't I just do a quick lead to Kimberly, and then you'll jump in, Kimberly. And it sounds like with that example, Taryn, that we're coming back to the P-Federalist argument. So I assume the commissioners in Alabama felt that addressing wind damage was really important, given the impacts that they're facing, and decided to work with the insurance industry to figure out this kind of solution to address the problem. So really kind of good to see that state regulator to the insurance industry delivering the products, to a certain standard. That's a great example. All right, so let's keep going here. So this is an opportunity for all of you to advise the White House. So we'll just kind of start there. In January of 2021, as all of you know, the Safeguarding Tomorrow Through Ongoing Risk Mitigation, or STORM Act, was passed in Congress. And this is a $500 million program to be offered through FEMA to provide capitalization grants to states, tribes, and other government entities to establish revolving loan funds while providing hazard mitigation assistance for local governments to reduce risks from natural hazards and disasters. All right, so now with John Podesta taking the reins from Gina McCarthy at the White House, and all of you know Gina McCarthy is our hero here in Connecticut. He's going to be overseeing the climate change investments from the U.S. government perspective. So if you had the opportunity to advise him on how to spend that $500 million revolving loan fund, what would you say? And why don't we start with Stuart?
I would love to be able to make these kinds of recommendations, of course, directly to John Podesta. And I think one of the ways that money itself gets used most wisely is to be sure that we're looking across the programs and sort of thinking about the ways that things like other legislation and support helps get that money moving in the right way. That revolving loan fund program reminds me of early work that I did with CDFIs and impact investors, especially in Native communities. And so I think that akin to that, we have to make sure that that money flows in such a manner that's much more equitable than some programs start out as, and sort of begin at a point there where it's equitable resilience that's being funded at the very front of the system, if you will. And in doing so, it looks across to the BRIC program that's also at FEMA, but looks across at HUD CDBG, especially the disaster response, the DR money, and starts to say, here's how we're going to use this loan fund. And here's how we're going to build out what is essentially like a resilient CDFI model with a revolving loan fund kind of behind it, and be sure that what we're saying is both definitionally the same and operates together and not in these silos. Because anyone who's worked in the federal government or gotten federal grants or both, the gray hairs come when X program or X agency ministry won't fund one that's kind of, you're trying to cross the streams, right? And really align the funding. It's in some cases prohibited, or it just doesn't work into one particular program. So that'd be the first thing I would say to John Podesta as he looks at that money and the other funds that are flowing, because there's not a common framework yet out of the White House for resilience. It's one reason the NCARS Act is so important, is like, how do you get the common framework and spend that money in the most responsible way?
That's great. So it feels like across government and equitable resilience. Very, 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 very good. Why don't we go to Pete?
Yeah, on this one, I would say I'm going to resist the temptation to pick the favorite peril or hazard that I might personally have, because I think one of the things that's been really eye-opening in participating in this discussion has just been there are so many different ways to get after the problem, and no one of us has the exact answer. So I think when I think about this question and the discussion that we've had today, I think number one, the $500 million is certainly not sufficient to solve the problem. But what we heard a lot of today was, how can you use funding as a catalyst to get things going? And so I would think about, how could you use these funds in a way that could actually start propagating something that might take on a life of its own. And then the other thing, going back to a comment I made at the beginning, was I'd have to think locally. Maybe set some success criteria on how these funds would be used, but then really figure out how to create that catalyst at a local level. I think that, if you were to try to pick a particular area to focus nationally, I don't think you'd get the full impact that you could get from this funding than if you found ways to really deploy it at a local level.
That's great. So not sufficient. It would be a catalyst at the local level. And, just looking at it, revolving loan funds, what it brings to my mind in terms of thinking about big programs are the state revolving funds that the EPA administers for clean water and drinking water. This may be an opportunity to demonstrate that catalytic funding at a local level may lead to more investment in the federal government later on, using that as a model. So great. That's great guidance there. Taryn.
Sure, I don't have too much to add based on what my panelists said, but I would say that one, I'd love to echo what Stuart and Kimbler were talking about in terms of addressing vulnerable communities that are at greatest risk and really need the most support. And then maybe just one other thing I would add is ensuring that there's funding to support capacity building. What we hear time and time again from a lot of the state and local partners is, their staff is overstretched, or they don't have the expertise in-house, or they need more funding for tools and resources. So making sure that the money is not just for physical infrastructure or projects, but making sure that we're also putting people at the forefront of that and really building up for the future.
Excellent. Well, thank you all. That was great guidance. And thank you for the question. All right. So as we wrap up here, I wanted to give several of you an opportunity for some parting thoughts. So if there were, one thing that you'd like to leave our audience with in terms of the future of climate finance for resilience, what would it be? And why don't we start with Pete?
So I think if I could leave the audience with just one thing, because I think a lot of us are sitting here saying, how can I have an impact? Where can I be most effective? What role can I play? The thing I think I'd want to leave everyone with is find a partner. This is something in which you heard from the panel today. This is something that no one entity or individual is going to be able to tackle by themselves. So even if you don't know where to begin, start by looking for a partner, figure out what it is that you could bring to the table. It might be technical support, it might be financing, but find somebody who can complement you, or several organizations that could complement you, because I think you'll find that once you get started, the ball will really start to get rolling, and you'll be able to have impact much broader than you would have thought you could have on your own.
Excellent. Taryn.
Sure. Building upon what Peter said, I think my takeaway would be, we don't need to reinvent the wheel each time. We can learn from one another. And I would encourage everyone listening to look not just for examples domestically, but also look internationally, because there might be some interesting, innovative things going on in the space that we can learn from and grow from and scale action more quickly.
Fantastic. I wanted to say, think globally, act locally on that one. Stuart.
Yeah, it's tough to not echo the partnership piece that Pete brought up, because it's what brought us together with Zurich and found those ways of working together. I think one of the things that I would add that came out of that partnership that I was going to mention previously was the way that it empowers local people and does the right kind of storytelling is also something that is going to be important as we move forward. And that partnership brought a kind of community training, community capacity building, and awareness and storytelling that I think is really important. We know how important it is to have the data and the science and the facts, but being able to explain that and build capacity and do the right kinds of storytelling, not just when a disaster comes, but when we're trying to prepare and we're kind of bringing everybody together. I think that ends up being more fruitful if we really find strong ways to do that are very visual and bring local partners in.
All right. So thank you, panelists. Really, on behalf of Commissioner Mays, George Bradner, and the Connecticut Insurance team, the Connecticut Conference on Climate Change and Insurance, thank you all for this panel on resilience in action financing. I think you gave us a lot of things to chew on. And we've got a lot of work ahead of us to ensure that the public and private sectors are mobilizing more investment in resilience. And to the extent we're doing that, we're going to thrive. Thank you, Stuart, for that. And it's on all of us to figure that out, because climate change is here today. It's impacting all of us, and enabling more investment to flow to help families and businesses weather those disasters or things that are coming, or prepare for and just enable us to live better lives, I think is the lesson. So if you're interested, there are a few resources that our panelists are going to provide to you. Feel free, when you go and listen to this on YouTube, in the description, take a look. There'll be a few links that might be useful to each of you as you delve further into climate finance and specifically financing resilience. So thank you, everyone.